projects in this country, and so he comes to us with tremendous amount of experience. Thank you very much, engineer, for finding time to be with us this morning. First of all, when we talk about project financing and bankability, what are we talking about? These are relatively new terms in town.
Thank you very much, O'Brien. It's my big pleasure to be with you. You are right that I've experienced leading over 30 years in project development, management, and implementation. And I've gone through the whole cycle of project initiation, project planning, project design, project implementation, monitoring and evaluation, up to project closure. And over those 3 years, I've experienced all that it takes to ensure that a project is delivered in time or lost in time. When we are talking about infrastructure projects, we are talking about both systems, physical systems, organizational systems that helps our society or our country or even our city to function efficiently. There are actually two types of infrastructure. We have the hard infrastructure, and that goes into areas like roads, railways, ports, whether it's marine ports or airports. And then we have another type of infrastructure, which is the soft infrastructure. It is associated with the human capital. In Kenya, we are endowed to have over 30,000 engineers, and more are being produced. So we also have the governance system is very crucial. It's an infrastructure system. And we have the regulatory infrastructure as well. So your question then talks about financing and bankability. Over the years, we have been dealing with project funding. While dealing with project funding, the main aim was to look at who will fund the project. So we have been using sovereign debt to fund projects. The government will initiate projects and use sovereign debts to secure loans and fund projects. We could also be using grants. And that has been the method we have been using to fund projects. But we have reached a point where, like you say, there's construction everywhere. There is organizational infrastructure development everywhere, schools, hospitals. What has happened is we have reached a level where we are constrained in the resources available, whether they are coming from DFIs or whether they are coming from the government itself. The Treasury can no longer afford either to grant sovereign guarantee or produce the funds. And that is why we need to move from funding to financing. And in funding, it was purely a planning issue by government. In financing, we need more stakeholders. For then we need projects that are bankable. What do we mean by bankability? Bankability means that all projects require CapEx. CapEx is the amount of money or the fund that is required to develop an infrastructure project. Now, once that CapEx is determined, the project could be of social good or could be of economic good or both. However, because of the constraint of the lack of funds, you have to bring other players. We have to bring the banks who are the owners of capital. We have to bring other players. So the point is, a project needs to be attractive to the owners of capital. May they be banks, may they be the DFIs, may they be, now we are moving towards financing through institutions like insurance institutions. We are moving towards the owners of capital like NSSF, like pension funds. They all have money, but for a project to be attractive to them, it must be bankable.
this has been said for many years that when you look at Kenya's infrastructure funding gap, you're looking at about $5 billion US. This is almost almost 600 billion Kenya shillings every year.
Yes.
And this gap is constraining or constricting economic growth at a rate of 2.something% every year. If we were to employ the model that you are talking about, how will these resolve this crisis?
Thank you, Brian. Look, we have a lot of passive funding or funds which are resting within our institutions. Pension schemes alone have in excess of 22 billion in terms of investment. Mm-hmm. All of it may not be liquid, but definitely far much more than half of that is liquid. But the amount sits there. You go to institutions like insurance, they are looking for space where they can put their money. You go to NSSF, they are looking for investment so that they can get returns when they need to pay the owners of the owners of the money when they retire. Mm-hmm. So how to move on then is ensure that the projects are bankable. Bankability, again, has to do with structuring a project in a way that it secures the returns. For example, when you are talking about energy infrastructure, are we going to get returns through selling of the kilowatt hour? Or when we are talking about user pay for a road project, are the people willing or the citizens willing to pay for utilizing the facility? Once they are, and if you check, like for example, we have Nairobi Expressway, now we are doing Lironi Mau Summit. There's proposal to do even Mombasa, Nairobi. Citizens and owners of capital are ready as long as the soft infrastructure is taken care of. The soft infrastructure deals with human capital. It deals with regulatory framework. It deals with the aspect of putting those together and ensuring that there's no risk to the money, to the owners of the money. So yes, we need to look at the bankability so that we can attract capital and fund project and close the funding gap. What you have just mentioned is true. The track of closing the funding gap results in economic constraining to the tune of 2% annually. While the opposite is also true, that if you close the funding gap to the tune of 5 billion, you are likely to attract 4% growth of GDP annually. So by the end of last year, within year 2025, our economy grew by 4.6%. Our target, for example, for Vision 2030 was double digit, say 10%. So if we are able to close the gap, the infrastructure financing gap, then we can grow the economy and even achieve our Vision 2030 within a very short time. So we need to move from the old methods of funding projects to the new ones which are innovative and involve the users of the infrastructure. Yes.
And I like the fact that you've talked about the Rironi Mau Summit highway, which is being financed using that model. And you are involved in the planning and the execution of the SGR from Nairobi to Mombasa, or from Mombasa to Nairobi and then to Naivasha. How different are the two models? Because one of them was through loans and exchequer funding. The other one we're using the PPP model.
Interesting. The one from Mombasa to Nairobi and to Naivasha, including the dry ports associated with it, was funded through concessional loan, and that was from Exim, the China Exim Bank. Actually, it was funded to the tune of about 92% was from Exim Bank, and about 8% or 9.1% was from the government of Kenya. Why was it that project, for example, bankable? Because there was traffic. The owners of capital here, who are the China Exim, could see the potential, the revenue streams that were going to be realized by connecting Mombasa to Nairobi. So it was bankable. The project was bankable, and they could easily extend the money. But when you move, for example, from Naivasha towards Kisumu and beyond, you'll find that the cargo throughput reduces to almost 25%. So in terms of its attractiveness, nobody will give sovereign guarantee for such. So we must then...
So cargo volume beyond Naivasha drops by 75%?
Look, the throughput in Mombasa is 100%.
Yeah.
5% is for the coastal region. 65% is for Nairobi.
That 65%.
Yes. So what we are left with 70%. 25% is for Eldoret, Kisumu, and the like. So 25 is for outside the country, the region, East African region. So in terms of the revenues projections, we need what we may call a gap funding, or some kind of crucial of the viability gap, because it will make economic sense, because we need connectivity within the region, but financially it needs gap funding, and that's where private capital needs to come in. And private capital could be anything. It is from FDIs, foreign direct investment. We have local direct investments. Our spread of the GDP is skewed towards a few people at the top with a lot of money, which can, if the projects are attractable, they can be encouraged to fund. And also the dormant passive money that is with our institutions. So the two are different in the sense that this one was highly bankable. The other one needs closure of the gaps.
When you look at Kenya, we are at a state what at the UN called developmental stage, whereby you are going to see a lot of expansion in roads, in railways, in ports, airport, water infrastructure, energy, hospitals, and so much. And when you look at us as a nation, which other areas do you think the financing and bankability levels are high, apart from the railway and the Nairobi, the Rironi Mau Summit Highway?
Look, the whole world is moving towards AI and data centers. So the aspect of energy production and also storage of it and training of human capital in the line of AI is very crucial, because to keep up with the UN and to keep up with the sustainable development goals and to keep up with the projections of economic growth, UN projects that for us to be able to grow and to develop, we need to sustain, for example, 7% growth in GDP annually. We were at 4.6% by last year. It keeps on varying. We'll get the growth by the end of this year. But the thing is, for us to remain in the League of Nations, for us to remain in the growth momentum, we must find a way of increasing the growth in GDP. One way to do it is through funding infrastructure. And it is all infrastructure. May they be transport, may they be energy related, may they be citizenship related, like the social aspect of health and education. We need to fund all of them. Why? They will contribute towards the over 2% annual growth. And then we will have impeded the crashing, the squeeze that was there. So we need to get the funding gap so that we are able to move on in line with SDGs of the UN. And also, we are in Africa, and such institutions like AFTA and Afri-Exim Bank, they are all advocating towards intra-trade within the African countries, which is very low. It is at 15%, while the external trading with other continents is over 85%. There is no way of growing without the growing being local. So we need to move towards investing heavily in infrastructure, in energy, in the social aspect, in the hard infrastructure, so that we encourage economic growth, which then brings all the benefits. There's creation of jobs. There's increase of trade. A 10% increase in investment in infrastructure leads to about 0.2% increase in trade. It leads to about 2.6% increase in employment. When we were doing SGR, we were able to create over 30,000 employments. And so that's what happens also even in the new projects which are going on. So we have to look at the whole spectrum of infrastructure and leave none behind, because they are conjoined, they move hand in hand.
The government has created the National Infrastructure Fund with a target of raising as much as 1 trillion Kenya shillings. Right now, the figure stands at about 320 billion shillings through state divestiture from Safaricom, from Kenya Pipeline, and so much. Is this an avenue that we can pursue as a nation towards attaining what we call self-sustainability funding model?
This NIF, the bringing it of it together was a brilliant idea. Because what it does is it gives a platform where we can crowd institutional funding like NSSF, like pension funds, like I don't even see the reason why we should not think of how to utilize the UFFAA, the Unclaimed Asset Fund. It is just their idle.
Even SACCOs.
SACCOs, yes, why not? But the point is, we need to deal with the soft infrastructure. The soft infrastructure has 3 things that are very crucial. One is governance. The government needs to create, and the players need to create confidence to the owners of capital that there is less risk. And if there is risk, because in projects development we always encounter risk, it is properly assigned to the person who can best handle it. So yes, NIF is a brilliant idea. India did the same I think in 2022. They have attracted over a huge amount of money towards infrastructure development. China did the same. The Southeast Asia did the same. Them, they were securitizing mature projects. So we want to grow. We must have homegrown solutions which give us money for financing infrastructure. But we must take care of governance. We must take care of regulatory framework, and we must take care of human capital. Human capital is not an issue for Kenya. We have invested heavily and we have enough of engineers to do designs and to do everything. But governance and regulatory framework, that is what is actually creating the infrastructure funding gap. Those two are the creators.
I've been listening to you and you've been talking about these 3 things, governance, regulations, as well as human capital. And you're saying that on human capital, we don't have a big problem.
Yes.
And this is where you have people like, engineers,
professionals, people, and all the professionals, yes.
Yes, coming together with government to, and as well as the workforce, to help in unlocking this. What about when you look at governance? Are we well architectured together with regulations?
The regulatory framework, and we even had this discussion before, is important because, for example, the owners of capital want to be sure that when a project is structured and is funded, the money will go there, it will be completed in time, the projected revenue streams that will come from it will come within the period of time that was in the plan. But sometimes we find ourselves having our projects spanning 3, 4 years, 3, 4, 5 years beyond the initial plan. That has to do with a challenge of governance, either poor planning, either there was an interference which was political, or, for example, you went on the ground and you are doing an infrastructure, say a road or a port, and then the owners of RAD say, no, you can't do it, and the time has started coming in. So we have a big gap there. And of course, not to mention, sometimes there is misappropriation of funds for the project. Nothing scares the owners of capital, Steve, like misappropriation. We must have patriotic people who run projects in such a way that the attractiveness that was there during project conceptualization is retained up to the end, including O&M, because then you guarantee the revenues that are projected. Then you guarantee the returns on the investment. The other thing is regulatory framework. We need conscious representation of the citizenship who make the laws that guide on how to implement projects. You don't want projects that start today and then after a change of, say, if it's a county, if there's a change of county administration, the whole project is no longer a priority, and you are halfway, you are midway. What happens? All that risk is borne by the owners of capital. So we have a long way to go, and I'm glad that we are keeping the discussion about the Constitution 2010 alive. There are many things we need to look at on governance and the cost of doing projects and the regulatory framework.
When you look at the period between 2007 to 2027, you're looking at 20 years, and Kenya, has seen significant changes in its infrastructural outlook. I mean, today you go everywhere, you see roads being constructed, bridges, and all these. Unfortunately, it has also increased pending bills to contractors, and nothing scares business people like knowing that I'm going to commit my finances into this project, but I'm not going to be paid. I mean, nobody's going to get into thieves. How do we get our acts together to ensure that we pay contractors on time, contractors, they complete the project on time and within the stipulated budget?
Again, it falls back to the soft infrastructure, the human capital, for example. All projects are manned and administered by experts. They must adopt what I may call a patriotic culture, that when we are doing it on behalf of citizenship. So when we have stated the project should be done within 3 years, there should be no reason why it should not even be done earlier. Why? Because we are trained and we are experts, we should exceed expectation to the public. So that side of human capital, we can handle it very well. However, the pending bills issue came because of, I would say, poor planning. We moved so many projects together, and then we didn't have, the budgets were getting constrained, and they were competing, for example, with our constitution. We have a huge wage bill, huge wage bill, whether it is the national level or even the county level. That was constraining the funds available for development. But thanks to the current administration, they have moved ahead and dealt with the pending bills. How did they do it? They did it through a funding model or a financing model called securitization. In securitization, you actually ring-fence the future income streams which come from a particular project, and you use it to create stocks or securities which are taken by the investors. Again, remember the owners of capital. Once they are confident that the money is secure, they give you their money, and through that method, the government has managed to settle the pending bills. They have managed even to handle the existing projects, And they are even launching new projects. So the thing is, that spirit should be ring-fenced through good governance. Remember? It must be ring-fenced through good governance. We should not just do new projects just because we want to do projects.
Yeah.
The project must be structured in a bankable way. Is it attractive to the owners of money? How can we invoke the passive money that is idle to be used for infrastructure? It must outlive the administration that proposed it. That way, we'll be able to do away with all pending bills and we'll be able to move forward. Yes.
Engineer, before I let you go in 30 seconds, I want to hear from you because this is a growing conversation and I will be calling you here so that we can advance this conversation. In 30 seconds, I want to hear from you. Where do we go from here?
Where we go from here, O'Brien, is we must move from the traditional project funding to project financing. For us engineers and all professionals, when we are structuring projects, we must do it with the end in mind. The end in mind is, can that project be sustainable? Can it produce its own revenue streams? And we no longer cannot work in isolation. We have to work with other players in the industry, like the legal minds, the PPP experts, and be able to ring-fence that income and use it to securitize. So the only way to move forward is to awake the passive capital and fund infrastructure from our own resources.
Very good. Engineer, thank you very much indeed for joining us this morning. Now it's afternoon. And of course, for sharing with us those great insights. I can tell you for free, this is going to be an ongoing conversation. And I will be tapping into your expertise and, of course, knowledge to help us guide in this conversation. Your time is highly appreciated.
It's my pleasure, O'Brien, and thank you very much.
Very good.
Thank you.
Engineer James Karanja is an expert in this field, I mean, with more than 30 years of helping government formulate strategies on how to implement projects, as well as coming up with funding and implementation matrices, joining us this morning and of course helping us understand how do we entrench the culture of ensuring that projects are well financed and they are bankable. Well, that is the first hour of this check. We're coming up next. We are looking at the digital credit market here in Kenya. It's growing at a very high rate and the regulations are there. What else do we need to do? That conversation is coming up after the break. Well, very well. I mean, the first hour is down. Let us now switch gears and talk about digital credit here in Kenya. I mean, Kenya is a pioneer in this business, bearing in mind that we became the first nation in the world back in the year 2007 to pioneer mobile credit through M-Pesa. Oh yeah, it should never get lost to us that we pioneered this concept. And this has grown to a point where by now there are more than 230 licensed digital credit providers in this country. And the Central Bank of Kenya has moved in to ensure that there are proper regulations to guide this industry. The question is this: what else do we need to do to help guide this industry and help grow it further? Kevin Motiso is the chairperson of the Digital Financial Services Association of Kenya. He's one of the founders, and he's very well versed in this field, and so he's joining us this afternoon. Forgive me if I keep on saying morning, because this check is always in the morning. But he's here with us. Thank you very much, Motiso. I have known you for many years, I mean, and I have seen you champion for the growth of this industry, the democratization of credit in this nation. I know you have been very, very passionate about these. Would you mind to give us a status update on where we are in terms of advancing credit, digital credit in Kenya?
Yes, so thank you very much for having me, O'Brien. This is always an honor and a pleasure to be here on KBC and BizCheck. First of all, we are 252 licenses. We're not 230. 252 licenses.
52, oh dear.
Yes,
and the number keeps on growing.
Yes, the central bank in their last statement to the public said that they have received over 800 applications, of which 252 have been licensed. We've gone through various evolutions over the time. I think since we got regulation back in 2022, the market has been growing. And I think the other big thing is that consumer complaints have come down by almost 75% since. What are the big things? So one of the big things that we've done is we've become an economic pillar. You cannot think of Kenya's economy without thinking about the digital lender. We are technically known as the digital credit provider. And why is that? We financed 68.4% of the borders on the road today. 68.4%. So back in 2013, there were only about 200,000 odd, what they call two-wheelers. Today, there are over 2.5 million two-wheelers. That has provided jobs to over 2 million men, because about 96% of borders are men. And the average border is making at least 1,000 shillings a day. You cannot deny that economic impact. The second thing we are very proud of is because the government made the necessary investments around what we call connectivity and internet penetration. We are now also the engine pushing for smartphone penetration. In fact, as recently as last month, we've reached 350,000 new smartphones lent out per month. And we've been doing an average of about 250,000 for the last 12 months. Again, that's economic impact. All those people who have found incomes through content creation, through ability to access the internet to do research. Of course, there's AI and etc. And then I think the biggest thing we're doing is, of course, providing working capital to businesses that had completely been forgotten. You know, about 80% of the businesses in Kenya are informal businesses. This means businesses that do not have any formal, they're not a company, they're not registered anywhere. And so for a long time, the banks did not give those types of businesses money because, as you know, when you get into a bank, you must have 3 years bank statements, you must have ngake. Today, we're able to provide that financing and working capital to these businesses based on the digital footprint they've created over the years.
Well, you know, in the last 10 years, we have seen Kenya create one of the biggest digital lending market in Africa, and one of the most regulated sector. And also we also a magnet of a lot of investors willing to venture into these markets. When you talk about 52 licensed operators against a request of 800, that the denial rate is very, very high. Why is this?
So actually it's not denying. I think what's happening is that the central bank's mandate, as you know, is price stability and currency stability. As a result of that, when they started regulating non-deposit taking credit providers, this was a new mandate. And so what they have decided to do is every quarter they release a certain number of licenses, and they're using whatever metric they're using to release about 40, between 25 and 40 every quarter. The truth of the matter is, because it is the central bank, one of the, you know, I saw today we're talking about the constitution. The central bank is one of those institutions that is, you know, credible and serious and very diligent. Our applications actually have over 1,000 pages of documents. And so it would be, I think it would be expecting too much of the central bank to be able to sort of go through so many
voluminous documents.
Yes, so quickly. So what they've done is they ensured that the major players all have a license. So if you look at the way the digital market is spread out, 90% of the ecosystem is 7 players. And then the balance of that is about 10 players. I mean, is the rest, the 252, 800 minus 7. It is everyone else in the 10%.
Yeah.
But the 90% is 7 players. So the 7 major players all have licenses today.
Very well. And when you look at this market, I mean, you're looking at more than 8.4 million loans that have been issued so far.
Yes. Well, annually.
Annually.
Yes.
Yeah, totaling to about 150 billion shillings.
Yes.
Would you classify these as small or big?
Well, it depends on your framing. If you look at the amount of money, say, Fuliza disburses on a daily basis, which is about 3 billion shillings a day, it's small. But when you look at from the base where we came from, which was as low as 100 million a month, and now we are doing, say, 15 to 25 billion, depending on the month, a month, that's a significant number. The more important thing to prove how important we are is where the money goes to. And as I said earlier, think about the informal worker, think about the informal business. That's really where we have made significant impact, because banks, for a fact, did not know how to get to that ecosystem, and now they have. Can we be bigger? I think that's what the objective is. I think we want to be more relevant. We want to see a lot of these informal businesses grow into formalized entities so that we can also issue bigger loans. One of the things we're very good at is because we are fully digital, we never have to enter a branch, but because they've been giving us their data willingly through the guidance of the ODPC's office, we know the customer. I can tell you which barber shop is going to do well. I can tell you which car wash is going to do well. I can tell you which mama mboga is going to do well, just by looking at their digital footprint today. Yes.
When you look at the Kenyan financial market, I mean, you have about 139 commercial banks. You also have a space for, I can't remember how many SACCOs are there, who are also offering credit to Kenyans. And now you're looking at 252 digital credit providers. And you have a population of about 56 million people. How many more from where you sit, and you come to us with tremendous knowledge and insight on this industry, having been there for more than 10 years, how many more credit providers can this market handle?
That's an interesting question. I've had this question being asked before, and my answer is always to look at other markets in the world. I'll give you a good example. There's a little country in Europe called Austria. If you look at Austria's total population, if it has hit 10 million, I'll be very surprised. But if you look at total number of banks, there are over 800 banks.
In Austria?
In Austria.
Wow,
right?
that's
so
huge.
the question is, the better question is, are these banks and financial services serving society in a way that is useful? That's what really matters. Because what you don't want to do is you don't want to limit, for example, entrepreneurial spirit. If somebody has a new idea of lending into a new vertical, and I've already given you a good example of Boda Boda, right? Many people would not have touched Boda Boda 10 years ago, for example, because they are men, people think they are rowdy, all these other things. But there are companies that said, hey, they are men that make money, and they need money for 1, 2, 3, and 4. Why don't we find a way to lend to them so that they can be more economically active, correct? So my approach is not to say there are so many banks, there's so many MFBs, there's so many this. No. My issue is are they serving the society we live in correctly? And is the regulator happy? If the regulator is happy, if the customer is happy, let's give the enterprise a chance.
I think the whole mantra is, because the market is highly democratized.
Yes.
If you find your space,
find it.
Come in, enjoy it.
Take it.
Let's talk about how do we help unlock the potential of this market, because it is huge. And one of the biggest challenge is the interest rate charged by DCP, bearing in mind that, and DCP, I'm not talking about the political party, I'm talking about digital credit providers. Yes. You're looking at between 5 and 15%, which is relatively higher. Is there anything that can be done to bring these lower to, let's say, 1 to 5% per month?
Yes, of course. And there are many things. So let's start with capital. Usually the problem we have is that the cost of capital in this market is very expensive. By the time you're borrowing from a bank, you're already at 18%, right? And then I have to add the risk. So if my risk as a business that has security is 18, what is the risk of a business that is informal and doesn't have any collateral? Could be as high as 30. Yeah. Then the other big challenge is that we are also borrowing or getting our capital in dollars. So there's that additional thing they call FX risk. So there's a foreign exchange risk. Fortunately, under this administration, we've actually seen a very stable dollar rate. Yeah. But you know, if you go back 20 years, even just 10 years, you know, we've had some very the dollar rate has fluctuated quite a bit. So imagine if I borrowed at, say, 100 bob at 10%, and then I came to lend in Kenya shilling, and then 2 months later, the dollar now is 130, right? You know, I'm already underwater. I've already lost money. Even if you pay me, I've already lost money. So the biggest challenge that causes this issue of cost of loans is actually the cost of capital. The solution is we are very active now trying to work with the Nairobi Securities Exchange to figure out how do we create instruments that, say, the pension fund ecosystem can take advantage of. As you know, the pension funds now have over 3.2 trillion shillings, right? But they are not allowed to invest in us. Why? You know, why? Why can't they invest in our instruments? So we're working with the CMA, we're working with the Nairobi Securities Exchange to figure that out. The other opportunity we are also saying is we want more local ownership in these businesses. So what we're also trying to do with the Nairobi Securities Exchanges, and we're doing a big event in September, where we're inviting all the big lenders into a room, and we're asking them, can you list on the stock exchange? Look at how well Safaricom has done. Look at how well the banks are doing. You saw Equity Bank's results, right? Let us be on the stock exchange, because then what the Nairobi Securities Exchange can be in the world, because we are pioneers, as you said, is a fintech securities exchange, where you have everything from the mobile money wallet like Safaricom, to the banks like Equity Bank, to the digital lenders like us. Yeah.
There's a case that you have always given whereby you have about 55,000 lenders who have accumulated debts of more than $1 million.
No, that's one borrower.
One borrower.
Yes.
Who has accumulated loan of
$1 million shillings and 71,000.
Using different...
About 50 lenders.
50 lenders.
Yes.
Oh, good Lord. And this is a challenge that has been brought about by digital credit providers not having a KYC kind of a platform. How do we cure this? Because at the end of the day, DCPs are in business and they want to recoup their investment.
Yes. So actually we did not cause it. This problem was systemic. Systemic meaning that the system as we found it as DCPs was not ready for the kind of speed. You know, the big innovation we brought is that we can approve a loan in 3 minutes. If you remember the old days, even in our lifetimes, you'd walk into a bank and it could take even a month before you got even the yes. Forget the money. Yes, right? So we have been able to do that in 3 minutes. Now, what that meant is that the credit reference bureaus were not ready because they were not real time. And people think that the credit reference bureau is a blacklist. And I know I've told you this many times. It isn't a blacklist. It's just a record of your credit behavior. So actually, when you borrow once and you pay your loan on time, it's in the CRB. It says O'Brien is a good payer. If you borrow 10 times and one loan you don't pay, it says the 9 loans you paid on time and the 1 loan you didn't pay on time. So it's a credit record. What have we done as an industry? So together with what we call the Credit Information Sharing Association of Kenya, that was mandated through the central bank when the CRBs came together, is we've created something called the Valley Data Tool. In fact, and what the Valley Data Tool is that we will now be submitting data into the credit reference bureaus through a single portal. So before, what used to happen, there are 3 credit bureaus. I am a lender, I pick one, I send the data there. So you can see how that customer got the 50 loans. Because if me, I'm sending my data here, and somebody's sending their data here, and another one is sending their data here, we don't have the full file on this customer. So now we'll be sending it to one single portal. That single portal will send the data to all 3 bureaus, and then what we will be doing is we will be picking data from one of our bureaus and seeing how that goes. Now, I want to just add something. As of August 31st this year, you will not even be able to submit data to a bureau directly. The single portal now will become the single point of sending data. So that, we believe, will be the big change.
And of course, the DCPs will also have access to this data.
Yes, because we're licensed. As a licensed financial services provider, by law, we are allowed to pull data and submit data.
Very well. Before I let you go, I also want you to tell me, what is the default rate in this market? I know banks, you're looking at, I think, 19–17%. What is the default rates for the DCP sector?
The problem with that question is because our types, you see, the difference between us and the banks is the banks have very similar products. Yeah, it's all long tenor, big ticket, etc. In my industry, I have somebody lending a boda for 12 months. I have somebody lending for fuel. Like me, I lend for fuel. It's 2 days. I have another person lending for cash, so it's varied. What I can tell you, though, is that there's a bit, it's up. It's up. And the main reason is the cost of fuel. In fact, our data is, you know, because we receive data so in a very real way, in a very real-time way. The moment the price went up the first time, we saw the default start to go up. Because that pressure that the fuel creates on informal sector business people is very tangible. Because, like, for example, Aboda, if I used to charge you 200 shillings, my margin was very clear. Then the petrol has gone up. I tell you 300, you tell me apana. Ulikuwa unanipatia, it used to take me 200. Why are you changing? So what this energy cost does is that it shrinks the margin. So I can tell you it's up. Can I tell you it's up 10–20%? I think that would be safe to say. So if we were at 5, now we're at 7. If we were at 7, now we're at maybe 9. Yes.
And I'm sure, you know, the DCP, as DCPs, you're looking at ways of managing these together with the market regulator.
Of course.
Kevin Mutiso, I mean, we would have continued to go on because this topic is very interesting and it's at the core of Kenya's micro economy.
Yeah, we're a pillar of the economy now.
Absolutely. Yeah. But I'll get in touch with you again sometimes in the future so that we can continue with this conversation and see how we can strengthen the sector.
Asante sana.
Your time is highly appreciated.
I appreciate you as well.
Very good.
Thank you.
Kevin Mutiso is the chair and founder of Digital Service Providers Association of Kenya, joining us this afternoon to give us a status update of that report. I mean, for the last 1.5 hours, we've been here on this check, and we need to bow out and give way to my colleague Khalid, who is on the other side. He's coming up next with Kurunzi Mashinani. Thank you for your time. Have a good afternoon.
Chessman on for the next game.
Yeah? You sure?
Yes.
Hey, there they are. Ah, very handsome.
Our girl is a little nervous.
Don't mention me. Don't mention me. I feel alone.